Og så skulle vi være live. Hey everyone, and welcome to another NewDeal Invest live Q&A here on YouTube. Thanks so much for tuning in. We're super excited to be able to connect with you all, investors and followers alike, in a direct format like this. And we hope you take the opportunity to ask us questions in the live chat, as we will be talking tech stocks and portfolio strategy for the next hour or so. For those of you who haven't tuned in before, my name is Jesper. I am part of the portfolio team here at NewDeal Invest, particularly for our smart portfolio, NDI-FutureTech on eToro. And you can find a link to that portfolio in the description below if you want to check it out, as well as the weekly writings we do in there. With me, as always, is Christiansen. Do you want to say hi and maybe share a few words?
Yeah, thanks for the presentation. So pumped to be going to be talking about the eToro NDI-FutureTech portfolio. We've been spending a couple of days in our portfolio team. It's Jesper and I, and then it's the guys from Convexity that are setting the portfolio, and we have a lot of discussions about which stocks to be in and out, and which themes to address. And we'll go over the stocks how we rebalance the portfolio, and there are some new stocks we're taking in, and we're eliminating one stock. And I hope that this will help you understand how we go to the portfolio management and sort of what we believe in is going to be the winning strategy for our portfolio. Yeah. So do come with a lot of questions, and the questions will mainly be on the stocks in the eToro portfolio. And then if you have some general questions about the market, about the maybe the AI demand or stuff like that, we've been talking a lot about whether or not to try to allocate more towards that, space tech, AI demand, and those kind of sort of larger topics, and also macro, although we're not macro experts, so don't expect too much there. Yeah. I can hear you, but yeah, I don't know if that counts.
Okay, now I think we should be back. I was just your sound jumped to my speakers for a moment, so I couldn't really hear you. But I think maybe it was only for the last 30 seconds or so. Okay, I think we should be good. Yeah, just before we get properly started, I just want to share that, as always, what we discuss tonight shouldn't be considered investment advice. We're here to be transparent and sort of share our thoughts, but please always invest at your own risk. So, Mads, should we just start by having a chat about the sort of recently quarterly rebalance of NDI-FutureTech?
Yeah, I think I would like to start with looking at sort of just the year briefly, to get people to understand the different segments that are moving, and then do come with a lot of questions. So here is Nasdaq is the line here over the last year, and then we have this purple one here, which is the SOX. It's a semiconductor index. And we have this lighter purple one here, which is Nasdaq equal weight. So we can see that the SOX, the semiconductors, has been really killing it for the last year. We also see that equal weight Nasdaq is only 22% up in the last year, versus Nasdaq. which is up 39%, and that tells us that the momentum has been in large cap, the biggest of Nasdaq, and I don't think it comes as a surprise to anyone after the last year, but that's just how it's been. So the green line, which I have down here, is the emerging cloud, EM cloud it's called. It's Bessemer Venture Partners. They have been running a small and mid cap cloud index for 11 years, I think now, from 2013. And I find it interesting that this one here has been really weak. I think if we have a small cap tech index, it would be sort of the same weakness we would see here. So it's really been about the last year about semis and about big tech. That's the trades that's been working. So if we go to year to date, we'll see that semis is only a little bit better than Nasdaq now. We'll see that this red one here, it's our Danish listed fund. It's public listed fund PMI NDI. It's kind of the same as Nasdaq. No, as it's a broad small and mid cap tech fund, and as you can see on the yearly chart, we're kind of performing the same way as Nasdaq. So that we're quite happy about that, because it's more weighted towards small cap and mid cap, which has not really performed well. So that was the 6 month. We still see the underperformance of emerging cloud stocks from Bessemer Venture Partners. But then if we zoom into the last quarter here, we see quite a different picture. We see that the semis has really underperformed the last 3 months. They are down with 5%. And we see that the emerging cloud is up with 6%. So we've seen this shift, and that's a very big part of our strategy, will be to rebalance towards what has been working, from what has been working and into what has not been working over the last 3 months, and you'll see that reflected somewhat in our portfolio rebalancing. Yeah. So I think we should go to the portfolio.
Yeah, let's have a look.
So here's the portfolio, and the chart here on the left is just the portfolio in the history of the portfolio. The portfolio was launched 1st of December last year, and we are up some 30% since that, and you can see it's been quite a volatile travel during the summer. We talked about that before the summer, that we've gone up so much, and we're entering into the low volume period. Everybody's talking about sell in May, and were we going to get the rate cuts, and everybody was sort of on the peak of the AI hype. Everybody was believing in AI infrastructure stocks, and I have an echo now, Jesper. Can you kill it? Thank you. If I can avoid listening to myself, that's good, and especially if it's out of sync. So that's the portfolio's performance, and we're really pleased with that good start. It's so nice to be there. And then I'll just start by looking at the portfolio. We have 44 stocks now, and we've got a few new stocks, and we've got some stocks coming out. We got 3 new stocks and 1 stock going out. So we are ending up at 46 stocks after this rebalancing. The stocks that I've just made them in alphabetical order, and the stocks that we are we are lowering the weight of is with the arrows down, Chewy is out. That's that sign. And hims and hers is an increase. That's that sign. And I just swapped the colors because green is usually something that is strong. And the one of the reasons for us to decrease the weight in the portfolio is to take profit. So when we are decreasing Broadcom here, it's because it's been very strong. And we feel that it's kind of where we want to take a little bit of profit, so we reduce the weight. And hims and hers has been very weak, but we believe a lot in the stock, so we increase the weight at this rebalancing. So that's why I just swapped the colors. So I don't know, are there any questions we should address right now, Jesper?
There's let's see here. We have Jørn asking, how do you sort of position yourself against? No, let's see here. It says, um, how do you yeah, position yourself against expectations of a hard recession when you're thinking about how much tech has gone up this year or over the past few years.
Yeah. Yeah, it's a side of two stories actually. So I'll just go back to this chart here because Jørn said now that tech has gone up so much. So I just wanted to zoom out on this chart here to give some perspective on that. And we're getting back to this is 2024. At least it could be maybe if I take the 5 year here. Yeah. So here is the downswing. We topped out late 2022, and we see this line here, which is the emerging cloud, which you should see as small and mid cap tech. So it's been beaten up pretty brutally in 2022, and it's still down a lot. Then you have semis here, which been on a tear since there. That was just a brief top for semis. It was also just a brief top for a Nasdaq because only a little more than 2 years later we were back at new all-time highs. So it's a story of big tech overperforming. And we see here is the equal weight Nasdaq. So the majority of the Nasdaq companies are actually quite mature tech companies. Nasdaq has been around since I think 1973. So all the companies entering 50 years ago or 40 or 30 or 20, they're pretty mature companies. So they've been kind of what the market has liked over the last 2 years. But small and mid cap tech is beating down. So that really begs the question, what to think about it if we get a market downturn. Could we see another 70% down for small and mid cap tech? I find that a little unrealistic. So it's not a likely scenario in my mind. If we go to big tech, could we see them going back and testing the bottom from 2022? I think maybe, yeah. So if we see a retest of that bottom, or if we go, let's just play with the scenario, we go back there, then it will be worst for big tech actually. So I think you need to understand that mature tech is performing different than small and mid cap tech, and you could actually make the argument that what we call big tech today is not tech anymore. It's mature business models that's been around for 15, 20, 25, 30 years.
Yeah.
So it's not tech anymore, maybe. So I think that's maybe the thing. Then what we've been discussing is a lot about the consumer, which companies would would have a hard time if the consumer gets weaker. And it was kind of one of the arguments for taking Chewy out. So it's been a part of the process, but then again, we don't know if we get a soft landing where
Mads,
everything is
can you
going to be
maybe
good, or a hard
expand?
landing.
Can
Yeah.
you maybe expand a little bit on taking Chewy out? Because Hjalte is asking why it's out since it's catching momentum again now.
Yeah. Yeah. So I like Chewy, and we have it in some of our other portfolios. Um, Chewy is a it's a 1P business, meaning they it's an online business. They deliver pet food and stuff for customers. They are building a SaaS business model for veterinarians, and they're also integrating vertically around pet medications and stuff like that. So they're really building a vertically integrated platform or service, which I really, really like. And I think that we'll see increasing margins, gross margins, due to a higher mix of ads and software sales and stuff like that. So I like it long term. It's just when we do these rebalancing, we only have 46 seats in the portfolio, so we really want sort of what we think is the best right now. And if we look at Chewy, then it's just been on a tear recently. Um, so
Yeah,
I'll just see if I can find it. It's up from something like 14 to 30 in maybe 6 months. So it's just seemed like a place where we wanted to take profit, and so it ended up with us taking it entirely out. Yeah. So that's kind of our thinking there. And I think it will be back, at least if it gets cheaper, more attractive, or something else get more expensive or something like that. So I think it's a keep. It's a long-term good investment, but it didn't make the cut here.
yeah. Like NDI-FutureTech is a little bit more concentrated than some of our other portfolios, and then that means that sometimes we need to make some hard choices. And so, if a stock like Chewy has really been on a tear for the past half year, quarter, sometimes we will take it out temporarily or not. Like the quarter previously, we took out Taiwan Semiconductor, even though that's also a stock we really like,
Yeah.
but that has just gone up, also really fast in a very short amount of time. And so for NDI Future Tech, to make room for others, we sometimes take out things a little more temporarily than we might in some of our other portfolios.
Yeah, and it's not because we think short term. I think of Chewy as a part of our portfolio. Right now,
Mm,
it's just with a zero weight on it, and it's because when something's gone up a lot, market was willing to sell it for $15 just 6 months ago, and now it's selling at 30. So and nothing, and I mean absolutely nothing has changed in Chewy. So yeah, we just felt that if we sort of look for things that could go right, then maybe we could get Chewy cheaper. But yeah, it's not something that I think or that I would advise. And if I had Chewy, I would not sell it myself, because I think it's a really good long-term winner due to what they're doing with vertically integrating over the entire space.
yeah. Mads Casper is asking, what are your thoughts on HelloFresh? It's also gone up quite a lot in the last short while. Should you consider selling, maybe? He's asking.
Yeah, HelloFresh is not a part of our portfolio here. eToro is only American listed stocks, but I'll briefly, I think HelloFresh is still very attractively. I think it was way too cheap. It's up double now. And yeah, we in those situations we take incrementally a little bit of profit for other ideas, or just to raise a little bit of cash to be able to to have some cash to buy if the market falls. That's kind of our way of doing tech investments. So,
Mhm.
but I still really like HelloFresh Group on the long term, and I think we're just getting started on that.
Do you think it's a stock that could potentially make its way into NDI Future Tech?
No, but no, it's not because it's not American listed. So that's the criteria for eToro for our NDI-FutureTech that we need American listed stocks. If it wasn't, it would have been there, and we would have taken profit now
Yeah.
because it's gone up so much. But yeah,
So in that case, it's maybe a little bit more of a technicality.
yeah, yeah,
Yeah.
it is. Yeah.
Okay. Hjalte is also asking, how do you vision AI evolving in Hims and Hers, the business model?
Yeah, it's what AI is doing is it's making data more valuable. So that's one of our themes. We're really looking for companies that have a natural source of data, because data is when compute gets cheaper, then it gets cheaper to do conclusions and do create value on data. And Hims and Hers is a company that is it's the digitized platform for a doctor-patient contact. So they get so much data that you really can't get anywhere else, from a patient doctor consultation. You need to record it, and that's what they are doing. And now with large language models, they're able to understand what is said, and then you can use that to create way better treatment, way better individualization of treatment. So if you're a family physician, you have patients of all ages. So let's say you treat hypertension. Maybe you get one patient with hypertension every day, and then you treat the patient with one drug where you can choose from maybe 10 drugs. So your experience with the individual drug on a patient gets very, very limited, even if you get a very experienced doctor. But that not for an AI model on Hims and Hers, because it'll be able to collect all those data, all those things that people say and how they react, and compare it to all other data that you have on that patient. So Hims and Hers is really able to make a better product. And then Hims and Hers is also a distribution platform, just like Shopee or Mercado Libre, or they're going to be distributing ads, and they're going to be helping people to find the medical service that they really need, and find the not only just treatment, but also other health things. Yeah, you can sell so much and distribute so much on that platform. So they're just getting started on that. Yeah, we increased Hims and Hers. I think we took a little bit of profit last quarter when the GLP-1
Yeah.
hype was at its highest, and then now we found it an opportunity to, because it was so low, and that's also when you see that, you just want to increase, and you need to find something that has to have a lower weight.
So that also means that Hims is one of our larger weighted positions in the
Yeah,
portfolio now.
yeah,
Yeah.
yeah, it is.
Do you think its whole business model is relying on AI to sort of fuel it, or do you think the 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 business model would work without it? Do you think there's any other ways they can sort of make a difference?
Yeah, I mean, there are so many, if you look at yeah, there's so many things that they do better. The availability, so you can go to your doctor from your own home. That's good. You can go to your doctor when you want to. You can it's cheaper because your doctor doesn't have to be there. He doesn't have to commute to an office in the city and pay rent and pay for a secretary and all that stuff. So it's just cheaper to deliver the service via the Hims and Hers platform. So yeah, so it's a good business model in my opinion. You can't do every medical service that way, but you can do a lot of them that way. And some of the services that there really is no reason to make it a really big project when it's just to look at how is your skin treatment going, or talking to the psychiatric patient. The psychiatric patients, many of them just maybe needs a little bit more frequent contact to feel like they can reach somebody and not be alone necessary. And that's easier. So you make a better treatment and you make a cheaper treatment. So yeah, that's really good.
Yeah. And I guess that's actually a pretty strong point, that, some of the downsides of our current sort of healthcare system is that it's very rigid, and it can be a little bit daring to maybe book an appointment and, have it fit into your everyday schedule. And then, so by lowering the barrier to entry, so to say,
Yeah,
HIMS might sort of just improve people's ability to even, have regular checkups and stuff,
yeah,
but just making it less frictionless.
yeah, exactly. And they have psychiatric diseases, and yeah, I think many or some. I actually think a lot of psychiatric patients would really like the availability, that when they're down, they can talk to somebody, and that they don't have to come to the city center and sit in a waiting room where there's lots of people and stuff like that. So I really think it has some merits to it.
Yeah.
And therefore we really love the business. And if the chart of Hims and Hers, I can just take it here also. I've been talking a bit about this in Danish, but not so much in for our English audience. But if you look at Hims and Hers here, then this is a chart. And and I think here probably in 2022 they lowered their prices on their platform and said they could sell a lot more if they did that. So that's why the DCF charts with the analysts just showed poor, low growth and stuff like that. And then they came up here and down again. No, I think it was here with the earnings in summer 2022 that they lowered their growth, their prices, and the reaction was negative. And then they came up to 12, and then they had a correction. And then the GLP-1 story started, and that's where we climbed to 26. So I think that this level here is a level that the market has been willing to pay without the GLP-1 story, and the company has just been smashing it ever since. And they have a lot of free advertising due to the GLP-1 story. So there's no way that I really can see this level around 12 not being the bottom for the stock.
Mm.
That's at least my thinking on it. Yeah. So we've been loading here also in the other funds because this was our perceived bottom at 12.
Yeah. Okay. Uh, we have a question from, actually, before we went live, from Nina Maria, and she says, this is not exactly a tech-related question, but I heard you, Mads, talk about Novo Nordisk in the podcast,
Yeah.
and I'm curious about your current view on it and where you see it in the future, the near future. And perhaps you could also maybe talk a little bit about why a stock like that wouldn't be part of our universe, perhaps.
Yeah, so Novo Nordisk is one of Europe's biggest companies, a very big part of the Danish economy. It's a huge company for a small country like Denmark, but they're doing diabetes treatment products, and has been a very successful company in innovating First the insulin for type 1 diabetes, and then various treatments for type 2 diabetes. And then they figured out that that some of the types of molecules that they were working with could be altered and could be used for obesity treatment. And that's been really a blockbuster for Novo Nordisk, and it's been on a tear stock wise. It's a biotech company and or a pharmaceutical company, and they treat diabetes and obesity. And I think if I put my tech glasses on and look at Novo Nordisk, I would see a tech company with two problems they're solving and two products, and then a product pipeline. So I would see a rather I would look at something and I would think it was a small portion in my portfolio. I think it's a good bet. They've really proved that they are the best or best at innovating and stuff like that. But I would really be cautious not to let it have too big a weight in my portfolio if it was a tech stock. So if I should say what could cause problems for Novo Nordisk, it would be other companies developing something better. And I would, if I should bet on a company developing the next new thing inside this, it's Novo Nordisk. But sometimes I think what Daniel Kahneman calls availability bias makes you blind to how hard it actually is, also for a company like Novo Nordisk to compete against all the other pharmaceutical companies in the world, of making the next big thing. So we probably are too certain that they are going to be able to create it. I think we learned that lesson from tech, where we think that this company is going to win, and then suddenly a newcomer has a new and better product. That's what we call best of breed inside tech, that suddenly a new company has something better. Yeah, so I guess that's my take. I think it's a good company. I think it should be a small position in a portfolio, and it's a
Yeah.
biotech company, so it's not in our portfolio, because we look at the companies that are digitizing the world.
Yeah, true enough. I mean, it to some degree, you can sort of view them as a technology company if you really want to stretch it. I mean, they are very innovative, that's for sure.
Yeah,
And I think also maybe a little bit ahead of the curve to their nearest competitor, Eli Lilly, because they were first with these types of products, and I think that's interesting. But yeah, it's a very well discussed and covered stock in sort of Denmark, where we come from, where our fund is based, and so it takes a lot of it gets a lot of chatter and coverage. But I think maybe Danish investors also have a tendency to be a little bit overweight in not only Novo Nordisk, but also just Danish stocks in general. And that can be a little
yeah.
bit dangerous, sort of not looking outside your own little bubble.
Yeah, but what's worked the last 20 years might work the next 20 years, but history tells us that that's really a poor argument, because it all comes down to whether the next technological innovation is good. And a thing that's happening too is that I think the barriers to entry is falling, because of technology and AI and simulation. We have some portfolios in the larger, some companies in larger portfolios like Certara and Schrödinger, which are into biosimulation. So they're actually making it more predictable how a molecule would perform, both in terms of the effect that you're seeking, but also in the bioavailability and how it's moving around in the body, where it's transmitted, and what could be a side effects. So, like if you want to research a molecule that could do something that you want, then you're reducing the number of molecules you need to test in mice and humans before you have a treatment. So it's getting less capital intensive to bring a new drug to the market. So
Yeah.
I don't know if that's an advantage to Novo or a disadvantage, but my intuition is that if you won the last technology era and something is changing dramatically the competitive advantages, then at least you need to you need to get that thing right as well. And I think it's not so obvious that you'll win in the next era as well.
Yeah. And I mean, in some of our broader portfolios, we have a lot of biotech names now that have sort of been pushed into the scene by the advantages of AI by NVIDIA. And so those are potentially sort of the next wave to come.
Yeah.
And it'll
Yeah.
be really
But
interesting to see where AI will take this whole space in a
yeah,
couple of
but the
years.
companies we'll invest in will be companies that are delivering the compute or delivering the software
Yeah.
for biotech companies. So we don't invest in biotech companies.
Yeah. All right. Mads, would you be okay to just return to HelloFresh Group for a little while? We have another question about it.
Yeah. Yeah.
Yeah,
Yeah.
so JT is asking or saying that he keeps stumbling upon ads from HelloFresh Group, and he was wondering if you could comment on where they might be strategy-wise. Is it because of increased competition? Could it be because they're, needing more customers? What's the reason for maybe them going aggressive on an ad strategy right now?
Yeah, so one of the things to really like about Hims and HelloFresh Group is when they wanna invest in growth, they have so many opportunities. They can choose between different geographics, and they can choose between different product categories, and also different brands within their meal kit business, for instance. So what you'll see them do is that they will have some marketing, and once they feel that they have a strategic advantage by pushing marketing in Denmark, etc., they'll do it. So it's probably because they see good return on investment in ads there now, and what they've seen over the past 2 years is that they haven't really been able to market really successfully on their meal kits, but they've had a lot of success with Factor. So they've prioritized Factor, their ready-to-heat business in the States, and building new production facilities there, and they're taking the Factor brand to Europe now. So that's been where they've been allocating the majority of their marketing spend. And then they are waiting for the consumer to get a little bit stronger before they'll start advertising for meal kits again, because consumers see meal kits as a little bit discretionary. And I don't do much cooking, so I'm not sure about this. But what you'll hear the meal kit industry say is that they're about average. They're about even with the price that you usually pay per meal if you go do the grocery yourself. But I think most people feel that they can find some offers and get things cheaper. And I think people don't calculate what they're throwing away into the mix, into the cost price. So meal kits are perceived discretionary, something that you only buy when you have a little bit more cash. And now that rates are high and stuff like that, prices have gone up and stuff like that, then yeah, then they don't see a good return on their investment in growth. But at this price level where they are now, they really don't need to. They just need to show some more profitability just by not investing so much. Coming out of COVID, they saw large growth, and they were investing a lot in logistics, and building out capacity, and they're sort of they're taking their growth expectations down. That means they don't need to invest so much, and that means they'll be more profitable.
Yeah. Okay. Well, yeah. Um, I mean, I think,
Should we look at the portfolio? Just go through
yeah,
it.
I mean that might give people some context if they
Yeah,
actually know maybe what some of the stocks that we've added this
yeah.
quarter and so
So I'll
on.
just, I think I'll just go through it briefly, and then people can sort of ask questions what they want me to
Yeah,
fold out a little bit. So
sure.
we have Amazon. We like the business, and we have it at 2.16%. So we just left it there. Then we have Broadcom, which we also like. It's been strong, and it's been one of our top picks. And now we're taking it down a little bit in weight because it's had a good run, actually, as one of the few semiconductor stocks. Bill Holdings is it's really a play on us, on the society getting back to growth. It's a play on small and medium businesses, their economy, and and we're waiting for that. But the stock market is always 6 months ahead, and I think suddenly Bill will start taking off again because we're getting closer to a stronger economy. Instacart is a business model that I really, really, really like. It's retail media, and they're building a SaaS business for supermarkets. So many people think that Instacart is a delivery business model, and that's what I really like because it's misunderstood. So it's becoming more and more of a software and ads business with higher and higher margins and improved profitability, and it's been performing really well. But we just left it at 1.9%. Chewy, we
Mhm.
talked about,
Yeah,
and then we have Coupang, which has also been on a really good performance. It had a quarter where it was misunderstood, and I think it fell to like 13 or something, and now it's trading at 26. So I think people that don't know tech stocks will think, "Oh wow, it doubled," but here it's just like, "Oh yeah, it doubled." Yeah, yeah, but
yeah,
it'll be cut in half next quarter. So we'll just take a little bit of profit now and see how things are. And it's not like we think it's going to fall. It's just like we think it could go either way, because you didn't think this and that stock could fall 50%, but suddenly it just did,
yeah,
for one of the other reason, like CrowdStrike. If you told people like 4 months ago that it be cut in half, then people would, no, 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 it's a magic business. It's a leader in cybersecurity and stuff. And then suddenly there we were.
yeah. Regardless, it just limits the upside, right? On
Yeah.
the short term. So,
Yeah, yeah, it skews the risk reward balance.
mhm.
Um, yeah, and Cisco, we really like Cisco. They have a lot that they're building on SASE and networks, and but it's very cheap, and market is starting to like it, so we keep it at a rather high weight. Carvana is still cheap actually. And but yeah, it was 4%, so now we're taking it down, but still one of our biggest positions. From what I see from Yipit data and stuff like that, then the market is underestimating the growth that Carvana will show in Q3. And we have DoorDash, which is a business we really like. They are yeah, they're just innovating, building new stuff, incrementally, just taking a little bit of market share from Uber Eats in the States. Bolt is performing well in Europe. dLocal is a stock that is really cheap on the numbers, and it's due to a short story. So dLocal is for us a stock with a lot of market pessimism, where we actually think the stock is okay. So and we really like to invest when the market is pessimistic about companies. Duolingo is has been on a tear, but and we would have reduced it if it was not just 2% now. So we're just leaving it there. Fastly is quite interesting. It's content delivery and building something like Cloudflare. They're just not executing so well and not being so innovative, but it's really cheap and it's a good business that Jordan understands really well. So we keeping it here. But yeah, probably if they get cybersecurity right and they get good at AI on the edge, then maybe there could be a case that they could be a good business. But right now, we just love to see it fairly priced to maybe to look for something else instead of it. Fortinet is a great business, cybersecurity, that we really like, but it's also gone up a lot. So it's not only what we think about a company, it's also what we think the market could do. And when the market has increased something in value with 50% or 100% over a short period of time, the risk of the market thinking suddenly that it's too expensive is high, and then we'd rather take a little bit of profit. So Fortinet is a long-term keeper, but we're weighing it down a bit. Globally is this cross-border e-commerce facilitator, and they've been having some headwinds due to the weak consumer, especially within luxury. But they're coming out now in half two with their partnership with Shopify, which should increase volumes and numbers. So it should have some tailwinds. Yeah.
Yeah.
GitLab.
Mads,
Yeah.
maybe just scroll through the list and then just maybe talk about the ones that
Yeah. Okay.
we have
Yeah. Yeah.
increased or
Yeah.
decreased or
Sorry.
added. No
Yeah.
worries.
Uh, GitLab, no, Hims and Hers, we talked about that.
Yeah.
Yeah, I think Intel is a special one. We think the risk reward is good, but we don't want to increase. We just want to see what happens. Mercado Libre, it's just Mercado Libre sort of have a trading range. It's going up in a channel, and it's at the top of the channel, and it was having a large weight, and we'd rather leave ourselves open to liking to buy it at a lower price if it falls back. It's been leading the tech stocks for the past 2 years, being the first one to appreciate in price, but also the first one to top out. So that's why we are just looking for a similar pattern this time. Open Door has just been smashed down. We think Open Door is really cheap compared to what you buy. We're not sure it's going to sort of pick up high growth. We think that growth will be too capital intensive for Open Doors. So yeah, but we also like to increase in something that's fallen, and that Open Door is very volatile. So we like to increase when it's come down, and that's what we are trying to achieve here. Oscar is just a wonderful business that's performing really well, getting to profitability, a health insurance company. Yeah, we just took a little bit of profit, but want to keep it at a high weight still. Qualcomm, yeah, is quite cheap, and we think the whole auto PC edge AI story is something to look for in Qualcomm that should give Qualcomm some tailwinds. So it's had a correction, and we bought into that. Rambus as well. We had, after the first day, we had Micron coming out with their numbers and really showing us that memory demand will be high, and we chose to increase Rambus instead of Micron, because the market seems a little bit more pessimistic, or maybe overseeing Rambus for now. Sea Limited really strong, but getting closer to something that you could argue could maybe be fair valued, especially depending on how you understand the company. So again, just to take a little bit of profit, and so that we would love to buy if it falls back. We like our positions to work both ways if they fall increase. Super Microcomputer is, yeah, It was down to 1.1%, so we increased it to 2, and it's a little bit of a gamble. I don't think I'll talk so much about that. We've made some extensive analysis of Supermicro on our blog in the portfolio, so you can go there and take a look at it.
Yeah.
There is a risk of them being delisted, depending on the SEC investigation, and they need to refinance that debt. So there are some tangible risks, but there also seem to be the company with the best technology for data center infrastructure. So it's a tale of two sides. And then the last ones here are Snowflake. We just think it's cheap. We think the market is over pessimistic about the competition with what's it called? The non-listed. Uh, yeah, it just fell out. The non-listed competitor for Snowflake.
Oh,
Um,
I don't know what I think.
yeah,
Uh,
okay.
so in what is it in cloud?
Yeah, yeah. It's also in memory. It's a data lake company. And never mind. But yeah. So we think Snowflake is in a good place, but the new CEO needs to prove something. Tower Semi, we bought that because it was just way too cheap after the Intel deal fell apart, and it was a value play, and now we're taking a little bit of profit.
Mhm.
And then Unity, just taking profit a little bit off the table. Again, we don't know how the market will perceive Unity in the future, so nice to take a little bit of profit. And then the new ones we're taking in is Confluent, NVIDIA, and Grab. Um, Grab, we've had that in, and we felt that it wasn't looking cheap, so we took it out last time, or maybe in the Q2
Yeah.
rebalancing. But now it feels like the market is starting to appreciate Asian stocks somewhat more, and um, and then we just want to have a part of Grab. It also gives us great diversification towards Southeast Asia. So that was, yeah, that was kind of the reasons for that. It's good for our portfolio to have some Southeast Asia in it. And then
S-
NVIDIA is, yeah, NVIDIA, we've stayed away from NVIDIA because we felt that the downside risk was too high, and NVIDIA has been just surprising to the upside. Jensen Huang has also been educating us over the last 9 months about how it's not only AI, but it's also accelerated compute that they are building chips for. And the demand is not only AI, it's also accelerated compute, which is used for a lot of other things than just AI. And yeah, so we really like NVIDIA, and I personally think it's the best investment over the next 10 years if you want to put your money somewhere.
Yeah.
So I think, Jesper, you'd say Tesla. Uh,
Probably, yeah.
yeah.
Um, or Unity if I'm daring. Actually, Wes, Sen is asking for three top picks right now, and I guess you just revealed number one, which would be NVIDIA for the long term.
Yeah,
What are
for the
your,
long term,
yeah,
for 10 years, something like that, I would take SoftBank as well, because it's a cheap way to buy ARM.
yeah.
And I think ARM is going to be very, very crucial, and the centerpiece of the compute build out we're going
So
to
it's
see
really
over.
just a way to get a discount on ARM, which you really
Yeah,
believe in. Yeah.
yeah, yeah, it is. And then you get a vision fund and stuff like that. And yeah, long term, I would probably take Broadcom
Hmm.
as well, because they're the biggest company within data center infrastructure within connectivity. And then I think they're killing it with the integration of VMware. So yeah, that's
So
kind of the
that's
three.
And kind of interesting that they're all semiconductor picks in some shape or form.
Yeah,
Um, why do you
yeah.
think that is?
Yeah, I think it's because it's the biggest companies. So when somebody asks me about picks, I always say big companies because I don't need to call them and say that this didn't work. If I said Novo Nordisk and suddenly there was a genetic treatment for diabetes, I'd have to call everybody and say now I don't think Novo Nordisk anymore. And I don't think I need to call anybody and in the next year or 2 or 3 or 5 years and tell them that ARM or Broadcom or NVIDIA is going out of business. So probably that the place you find these big companies that are crucial for the next generation of tech is that semiconductor businesses.
Yeah.
Yeah.
John is asking why we waited this long to add NVIDIA to the portfolio.
Due to the downside, I think that we perceived it very much as a chip stock, a hardware stock, and hardware has a lot of has cyclicality. So we were sort of afraid of the cyclicality. Our portfolio started the 1st December last year, and we felt that it could be late for NVIDIA. And late for us would be we want to keep the stocks for not just 3 months or 6 months and something like that. And we felt we were maybe entering the late end of the move up for NVIDIA, where you really need to also be good at selling, and we didn't want to take that risk. But yeah, NVIDIA has just educated us on AI, on the accelerated compute, and then also on what kind of mode the CUDA platform really is, and they're building these libraries which enables you to use GPU chips for a lot of other things than just pictures and NVIDIA is the only one doing that. A lot
Mm.
of companies are doing that for their own specific purpose, but NVIDIA is the only company that is doing that for an industry. And that means that NVIDIA's chips will be the best because their libraries, hey, whoa, they're built for NVIDIA chips. So their software, they're doing it again, like they did with the shaders for computer games developers, and with the CUDA. Now they're doing it with their libraries, and yeah, so yeah, I
Yeah,
think
and
he's got it nailed.
I think also, we should give credit to NVIDIA for just continuously proving themselves. Like
Yeah,
when we started this portfolio, it was all NVIDIA hype and all that everyone was talking about, and so we had to be a little bit skeptic about, what was out there, and all the
yeah,
numbers were pumping up, and
yeah,
expectations were sky high, and then, through the last couple of quarters, they've just nailed it, and they've actually lived up to expectations, and it seems like they're continuing to do it, and so we also have to sort of take that into consideration when we're thinking about adding them to the portfolio because maybe the hype is justified or not, and that's sort of an interesting thing to learn when you sit here and try to put together the same or the best possible portfolio, and you just see this stock sort of doing what it's supposed to, and then that's impressive. And yeah, I think there's no doubt now that long term it's probably going to do very well.
yeah.
So,
And that means that the stock, when we're buying it here, it works both ways. So if the market slaughters it next quarter and it falls to 70 or something like that, we'll be buying like crazy because
mm,
we're gonna love it at that point. So
yeah,
it works both ways. Now we have a 2% position, and if it goes up, we're happy. If it goes down, we're extremely happy because will be increasing what we feel is a really good long-term bet. And I don't think that the demand for accelerated compute infrastructure is going to be in problems over a foreseeable future. You could get some value chain hiccups or stuff like that. So there can be things, but in general, we'll just be happy to buy if it falls from here.
Yeah, and I think that's also maybe something, people need to understand. Like, we do take profits for stocks that we really like in this portfolio, but that often means that we're still long-term bullish on them. And we
Yeah,
try to keep as many of
exactly.
them as we can. It's just, with an example like Chewy, we had to take it out to make room for some of the new stocks we were adding. But yeah, it can be a little bit difficult to maybe wrap your head around why we're selling out of the stocks that we like the most. But really, we're just trimming them a little bit and sort of balancing out the portfolio for the next quarter.
Yeah,
Yeah.
exactly. Yeah. We
Um,
haven't reduced any stocks that we don't like. We like them all long term, the
yeah.
stocks that we talked about today.
Yeah.
And yeah, and Confluent, we've liked that for a long time as well. We just felt it's been too expensive. So we felt the downside potential was bigger, and was so downside potential of a stock that you don't have but you like. That's an optionality, which
Hmm.
you can leverage, and that's a way to create value. So by not having Confluent, we've created value, but now we take it in because we feel it's cheap, and we feel that it's a good stock for the long term.
Yeah. All right, Mads. It's now 9 o'clock, so I think we should wrap
Yeah,
up. I just want to say thanks to everyone who tuned in. I hope you enjoyed us talking a little bit about NDI Future Tech, especially if you're, invested in a portfolio. We're really happy to see you here, and we just want to remind you that for the next times we go live, please ask as many questions as you want. We're here to sort of just show what we know and give you guys insight into what you're invested in. So yeah,
and go
um,
look the portfolio up on eToro. If you I think, Jesper, can we put the link in the show
it's
notes here?
it's actually in the top of the description already. So
Yeah, that's good because you can see the portfolio, you can see the weights, and you can get each week we put out some analysis on the stocks in the portfolio,
yeah,
where we go a little bit deeper into one stock at a time, and we have a weekly newsletter where you can follow macro and what's going on in the tech world. It's sort of just what we learned in the past week or what we've been thinking about in the past week. So yeah,
yeah. And if Confluent or Grab or some of the other stocks that we've added here in this quarter, is of interest to you, we'll probably be covering them in the next couple of weeks as we talk about the results of the rebalance.
yeah,
So yeah, I think that's all for tonight. We'll probably see you all in 2 weeks' time.
yeah,
Otherwise, yeah, enjoy the rest of the day.
yeah.
See you
Thanks for looking.
guys.
Bye. Thanks, Jesper.